Part 1 of the Income Tax Act, Cap 470. Part 1 of the Kenya Income Tax Act, Cap 470, is titled Preliminary and includes two main sections. Section 1. Short title and commencement. This section simply names the Act as the Income Tax Act and indicates when it came into effect. Section 2. Interpretation. This section defines various terms used throughout the Act. These definitions ensure clarity and consistent understanding of the legal language in the context of income tax. Some of the key terms defined include: accounting period. The period a person uses to prepare their business accounts. Business. Any trade, profession, vocation, manufacturing activity, venture, or concern similar to trade, but excluding employment. Dividend. Any distribution of cash or property by a company to its shareholders, except distributions made during complete liquidation of the company. Employer. Any resident person responsible for paying emoluments to an employee, including agents, managers, or representatives of non-resident employers. Immovable property. This encompasses land, estates, rights, and interests related to land. It also includes mining rights and interests in petroleum agreements. Individual. This term refers to a natural person. Interest. Interest payable on loans, deposits, debts, or other obligations. It includes premiums, discounts, commitment fees, service fees, and Islamic finance returns related to loans or credit. Resident. For individuals being present in Kenya for any period during a specific year and having a permanent home in Kenya. Year of income. The 12-month period commencing on January 1st and ending on December 31st of the same year. This section also allows for record keeping in various formats, including written form, microfilm, magnetic tape, or any other mechanical or electronic data retrieval method. It also addresses situations where rates of tax and personal reliefs are altered by orders made under the Provisional Collection of Taxes and Duties Act. Part 2. Income Tax Imposition. Part 2 of the Kenya Income Tax Act, titled Imposition of Income Tax, starting from page 14, focuses on how income tax is levied in Kenya. Section 3. Charge of tax. This section outlines the general principle that income tax is charged on all income earned by a person in or derived from Kenya. This applies to both residents and non-residents. The section further specifies that income subject to tax includes gains or profits from any business activity regardless of the duration, employment or services rendered, granting rights to use or occupy property, dividends or interest, pensions, charges, or annuities, including withdrawals from registered pension funds, provident funds, or individual retirement funds. Royalties or premiums for rights to use or exploit copyrights, patents, trademarks, designs, models, or similar property. Rent from property situated in Kenya. Natural resource income. Income from mining, petroleum, or other natural resources. Gains from financial derivatives, except those traded on the Nairobi Securities Exchange. It also clarifies that partnerships are not considered taxable entities for income tax purposes. Instead, income from a partnership is taxed in the hands of the individual partners. Section 4. Income from businesses. This section clarifies the taxation of business income for resident persons carrying on business activities partly within and partly outside Kenya. It states that the entire gains or profits from such businesses are considered to have accrued in or been derived from Kenya, and therefore subject to Kenyan income tax. Section 5. Income from employment, etc. This section explains the taxation of income earned from employment or services rendered. Gains or profits from employment include salary, wages, leave pay, payment in lieu of leave, fees, commission, gratuity, or bonus, regardless of where the employment or services were rendered, for resident persons. For non-resident persons, the above forms of income are taxable only if the employer is a resident in Kenya or has a permanent establishment in Kenya. Value of any benefits, advantages, or facilities provided in respect of employment or services rendered, if the aggregate value is not less than 36,000 shillings. Employer contributions to pension funds, provident funds, or schemes. Compensation for termination of a contract, which is considered to accrue evenly over the unexpired period of the contract. Balancing charge under the second schedule. Value of premises provided by an employer for residential purposes. Section 6. Income from the use of property. This section defines income earned from the use of property to include royalties, rent, premiums, or any other similar consideration received. It emphasizes that income from leases or similar transactions for lessors is determined based on rules prescribed within the Act. Section 7. Income from dividends. This section explains that a dividend paid by a resident company is deemed to be income in the year it became payable. Further, it deems certain transactions to be dividend distributions even if they don't take the typical form of a dividend payment. This includes situations where a company distributes assets to shareholders, discharges a shareholder's debt, or uses funds for the benefit of a shareholder in a manner that increases the shareholder's taxable income. Section 8. Income from pensions, etc. This section states that pension income received by resident individuals from funds or schemes outside Kenya is partially taxable in Kenya. The taxable portion is determined by the proportion of the total pension that relates to employment or services rendered in Kenya by the individual, their spouse, or parent. Conversely, pension income received by non-resident individuals is taxable in Kenya only if the person making the payment was a resident in Kenya at the time of payment. Additionally, the first 300,000 shillings of pensions and retirement annuities received by resident individuals from registered funds or the National Social Security Fund in a year are exempt from tax. Section 11. Trust income, etc., deemed income of trustee, beneficiary, etc. This section clarifies that any taxable income received by a person acting as a trustee, executor, or administrator is considered their income. It also clarifies how specific types of income, such as qualifying dividends and interest, are treated when received by a trustee, ensuring they are taxed appropriately under the relevant sections of the Act. Section 12C. Turnover and presumptive tax. This section introduces the concept of turnover tax for resident persons with business turnover exceeding 1 million but not exceeding 25 million shillings. This tax is an alternative to the regular income tax regime and is payable on a monthly basis. However, persons liable for turnover tax can opt out and choose to be taxed under the regular income tax provisions. Section 12D. Minimum tax. This section introduces the minimum tax, which applies when a person's income is not exempt and the installment tax payable is less than the calculated minimum tax. However, certain categories of businesses are exempt from paying minimum tax, such as businesses with government-controlled retail prices, insurance businesses, and specific manufacturing businesses meeting certain investment criteria. Section 12F. Digital Asset Tax. This section, added in a recent amendment, introduces a tax on digital assets. It defines digital assets as cryptocurrencies, including Bitcoin and Ethereum, and non-fungible tokens, NFTs. The taxable income from these assets is the gross fair market value consideration received at the point of exchange or transfer. This part of the Act lays the groundwork for understanding who is subject to income tax, what types of income are taxable, and how certain specific income categories are treated. It provides the basic framework for the rest of the Act, which delves into exemptions, deductions, rates, and administrative procedures. Part 3. Exemptions from income tax. Part 3 of the Kenya Income Tax Act, titled Exemption from Tax, covers situations where certain incomes are not subject to taxation in Kenya. Section 13. Certain income exempt from tax, etc. This section begins by stating that despite the income tax imposition rules outlined in Part 2, specific incomes listed in Part 1 of the first schedule are exempt from tax. These exemptions apply to incomes accrued in or derived from Kenya. Additionally, the section lists specific deductions allowed when calculating taxable gains or profits from business for a particular year of income, including bad debts deemed irrecoverable. A portion, 1/3, of the total employment income for non-Kenyan citizens working for non-resident companies in specific circumstances, such as those employed in approved regional offices and spending a minimum of 120 days outside Kenya for work purposes. Section 14. Interest on government loans, etc., exempt from tax. This section specifically exempts interest earned on loans issued by the Kenyan government or with a government guarantee from income tax. Part 4. Determining total taxable income. Part 4 of the Kenya Income Tax Act, titled The Ascertainment of Total Income, outlines how to calculate the total taxable income for individuals and entities. Section 15. Deductions allowed. This section focuses on deductions permitted when determining a person's total income for a specific year. General deduction principle. The fundamental rule is that all expenses wholly and exclusively incurred in producing that income are deductible. If income for an accounting period ending on a day other than the last day of the year is considered income for a specific year, expenses incurred during that period are treated as having been incurred in that year. This ensures expenses are matched to the income they helped generate. Specific deductible amounts. In addition to the general principle, the section lists particular deductible amounts when calculating taxable gains or profits, including bad debts. Debts deemed irrecoverable are deductible. Insurance premiums. Premiums paid on insurance policies are deductible. Contributions to approved retirement funds. Contributions made by employers to registered pension funds, provident funds, or individual retirement schemes are deductible. Capital deductions. Deductions allowed under the second schedule are applicable. Expenditure for repairs. Expenses for repairs of premises, plant, machinery, or fixtures employed in producing income are deductible, subject to certain conditions. Farming expenses. Costs incurred for preparing land for farming, planting, and maintaining crops are deductible. Research and development expenses. These expenses are generally deductible, though specific conditions apply. Training expenses. These expenses are generally deductible, but subject to certain conditions. Exploration expenses. Costs associated with exploration activities for mining and petroleum operations are deductible. Social infrastructure expenditure. This specific type of expense related to mining or petroleum operations is deductible. Losses. The section establishes rules for offsetting losses from one source of income against income from other specified sources within the same year. Section 16. Deductions not allowed. This section specifies expenses that are not deductible when calculating total income, including Domestic or private expenses. Expenses not incurred in producing income. Capital withdrawn from a business. Sums employed or intended to be employed as capital. Capital employed in improvements. Any loss or depletion of capital. Personal living and family expenses. Expenditure or losses recoverable under insurance, contracts, or indemnities. Income tax or similar taxes paid except foreign tax claimed under double taxation relief arrangements. Penalties are fines or interest charged due to late payment of tax. Expenses incurred in generating exempt income. Gross interest paid to non-residents exceeding 30% of the borrower's earnings before interest, taxes, depreciation, and amortization, EBITDA, in a financial year. This provision aims to discourage excessive interest payments to non-residents, which could erode the Kenyan tax base. Deemed interest in specific situations involving companies controlled by non-resident persons. The section also clarifies the definition of all loans for the purpose of calculating the interest limitation. Section 17. Special provisions relating to certain businesses. This section addresses specific business scenarios, such as farming businesses choosing not to value their stock when calculating income. It lays out rules for handling stock valuations upon cessation of farming activities. Section 18. Ascertainment of gains or profits of business in relation to certain non-resident persons. This section focuses on determining gains or profits for non-resident persons carrying on businesses in Kenya through permanent establishments. It disallows deductions for interest, royalties, management fees, or professional fees paid by the permanent establishment to the non-resident person. The rationale behind this is to prevent profit shifting out of Kenya. The section also disallows considering foreign exchange gains or losses between the permanent establishment and the non-resident person. It further clarifies that the term a non-resident person encompasses both the head office and other offices of the non-resident person. Section 18A. Ascertainment of gains and profits of business in a preferential tax regime. This section, a relatively recent addition, introduces a preferential tax regime for qualifying intellectual property income. It aims to incentivize research and development activities in Kenya by offering a lower tax rate. To qualify, the income must be derived from patents, copyrights, and similar intellectual property rights. It outlines conditions for accessing this regime, including requirements for substantial activities, economic substance, and transparency. Section 18b. Application of Sections 18c, 18d, 18e, and 18f. This section clarifies the applicability of subsequent sections relating to reporting and compliance requirements for entities operating under the preferential tax regime. Part 4 of the Kenya Income Tax Act plays a crucial role in determining the taxable income of individuals and entities. It establishes the fundamental principles of deductions, identifies non-deductible expenses, and addresses specific business situations. The sections on non-resident persons and preferential tax regimes reflect efforts to prevent profit shifting and promote specific economic activities in Kenya. Understanding these provisions is essential for accurate income tax calculations and compliance. Part 5. Personal reliefs explained. Part 5 of the Kenya Income Tax Act, titled Personal Relief, details the various tax reliefs available to individuals to reduce their overall tax liability. These reliefs are designed to provide some level of tax exemption or reduction for specific personal circumstances or expenses. Section 29. Personal relief. This section defines personal relief, which encompasses both the specific reliefs outlined in Part 5 and the relief mentioned in Section 30. However, the exact nature of the relief in Section 30 isn't specified in the provided source excerpts. Section 30. Insurance relief. This section grants tax relief for premiums paid on life insurance policies and contributions to the National Hospital Insurance Fund, NHIF, subject to specific conditions and limits. The maximum allowable relief is capped at a specific amount or a percentage of the insured person's total income, whichever is lower. This sets a ceiling on the amount of tax benefit an individual can derive from insurance premiums. To claim the relief, individuals must provide evidence of the insurance policy's terms and conditions. This ensures only legitimate insurance expenses are eligible for tax relief. The relief applies exclusively to life or education insurance policies issued after January 1, 2003, and health policies issued after January 1, 2007. This indicates a policy decision to encourage long-term savings and healthcare coverage. Education policies must have a maturity period of at least 10 years to qualify for relief, further emphasizing the focus on long-term financial planning. Section 31. Mortgage interest relief. This section focuses on tax relief for interest paid on mortgages used to purchase residential property. The relief is capped at a specific amount or a percentage of the interest paid, whichever is lower. Section 31A. Post-retirement medical fund relief. This section introduces a relatively new relief, post-retirement medical fund relief, allowing individuals who contribute to such funds to claim a tax relief. The specific details and limitations of this relief are not provided in the source excerpts. Part 5 of the Kenya Income Tax Act is designed to provide tax relief to individuals by recognizing their personal circumstances and encouraging specific financial behaviors, such as insurance coverage, homeownership, and post-retirement medical planning. Understanding these reliefs is crucial for individuals to accurately calculate their tax liability and maximize their eligible deductions. Part 6. Understanding tax rates, deductions, and double taxation relief. Part 6 of the Kenya Income Tax Act, titled Rates, Deductions, and Set-off of Tax and Double Taxation Relief, focuses on several key aspects of income tax calculation and administration. Subpart A. Rate of tax. Section 34. Rate of tax. This section lays out how different types of income are taxed. It establishes the general principle that income tax is charged at rates specified in the third schedule to the Act. The third schedule is not included in the provided source excerpts, but it is implied to contain detailed information on the specific tax rates applicable to various income categories for different years. The section further clarifies the tax treatment of specific income types, such as rental income. Tax on gross rental receipts from residential property is charged at the resident rate specified in the third schedule. Capital gains from the transfer of interest in a person. These gains are taxed according to the ninth schedule, which deals with the taxation of extractive industries. Winnings. The section doesn't elaborate on the specific rates for winnings but indicates they are subject to tax. Minimum tax. Gross turnover of persons liable for minimum tax under Section 12D is taxed at the rate specified in the third schedule. Digital service tax. Gross transaction value of services subject to digital service tax under Section 12E is taxed at the rate specified in the third schedule. Subpart B. Deductions of tax. This subpart focuses on the mechanism of withholding tax, where certain payers are obligated to deduct income tax at source and remit it directly to the Kenya Revenue Authority, KRA. Section 35. Deduction of tax from payments of interest by a resident person. This section mandates that resident persons paying interest on specified financial instruments such as bonds or loans deduct tax at source at the rate applicable to resident individuals. The section includes specific provisions for handling tax deductions when financial instruments are acquired from or disposed of to tax-exempt persons or financial institutions listed in the fourth schedule. The fourth schedule is included in the source excerpts and lists specific financial institutions. Section 36. Deduction of tax from certain payments. This section expands withholding tax obligations to cover a wider range of payments made by resident persons or those with a permanent establishment in Kenya. The payments subject to withholding tax include dividends, management or professional fees, royalties or natural resource income, winnings, rent, a premium or similar consideration for the use of immovable property, payments for sales, promotion, marketing, and advertising services, payments for digital content monetization. The section specifies that only individuals authorized by the KRA can deduct tax on rental income, adding an extra layer of control. It also outlines penalties for failing to deduct or remit the tax properly and the consequences for property transactions where the tax is not duly accounted for. Section 37. Deductions of tax from emoluments. This section mandates that employers deduct and account for income tax on their employees' emoluments. It outlines the obligation of employers to deduct tax according to prescribed rules and regulations. It also details penalties for employers who fail to deduct or remit the tax correctly and allows employers to object to penalty impositions. Section 37A. Penalty for failure to make deductions under Section 35, 36, or 37. This section specifically targets corporate bodies that fail to remit deducted tax amounts as required. It holds directors and officers personally liable unless they can prove their lack of knowledge and reasonable steps taken to prevent the offense. Section 38. Application to government. This section clarifies that the withholding tax rules also bind the Kenyan government. Subpart C. Set-off of tax. Section 39. Set-off of tax. This section deals with the crediting of tax already deducted at source against the total tax liability of a person. It allows the following tax amounts to be credited against the final tax payable. Tax deducted under Section 17A for non-individuals, 35, 36, or 37. Tax borne by trustees, executors, or administrators on income paid to beneficiaries. Tax paid under Section 12A not specified in the provided source excerpts. Subpart D. Double taxation relief. Section 40. Power to make special arrangements for double taxation relief. This section empowers the Kenyan government to enter into agreements with other countries to avoid or mitigate double taxation, ensuring individuals and entities aren't taxed twice on the same income in both countries. Section 41. Special arrangements to have the force of law. This section confirms that double taxation relief agreements, once made and published, have the force of law in Kenya. Section 41A. Agreements for exchange of information. This section grants the Kenyan government the authority to enter agreements with other countries for exchanging information related to income tax or similar taxes. These agreements aim to improve tax transparency and prevent tax evasion across borders. Section 42. Computation of credits under special arrangements. This section deals with the calculation of tax credits allowed for taxes paid in another country under a double taxation relief agreement. It outlines how to determine the amount of credit available to offset against the Kenyan tax liability. The section also introduces an important limitation on double taxation relief benefits when the income recipient in the other contracting state is predominantly owned by non-residents of that state. This provision aims to prevent treaty shopping, where entities are structured to take advantage of tax treaties without having genuine economic substance in the treaty partner country. Section 43. Time limit. This section sets a time limit of 6 years from the end of the relevant income year for claiming an allowance by way of a tax credit under double taxation relief arrangements. Part 6 of the Kenya Income Tax Act plays a crucial role in determining the final tax liability of individuals and entities. It sets out the applicable tax rates for different income types, establishes withholding tax mechanisms for various payments, allows for crediting of tax deducted at source, and provides for double taxation relief through international agreements. Understanding these provisions is essential for proper tax compliance and planning. Part 7. Persons responsible for paying tax. Part 7 of the Kenya Income Tax Act, titled Persons Assessable, clarifies who is responsible for paying income tax in various situations. Section 44. Wife's income, etc. This section establishes the general principle that each person is responsible for paying tax on their own income. This applies regardless of marital status. Section 45. Personal liability of agents of non-residents. This section outlines the liability of agents representing non-resident individuals in Kenya. It states that the agent is personally responsible for paying the non-resident's tax if the agent has control over the non-resident's income. The agent fails to pay the tax when due. This provision ensures that the Kenyan government can collect tax revenue from non-residents even when they don't have a physical presence in the country. Section 46. Assessment of agent or trustee. This section provides a mechanism for assessing tax when a non-resident's income is under the control of an agent or trustee in Kenya. It allows the tax authorities to assess the agent or trustee for the non-resident's income. The agent or trustee can then deduct the tax paid from any money they hold on behalf of the non-resident. Section 47. Income of non-resident person. This section clarifies that the income of a non-resident person is subject to Kenyan income tax to the extent that it accrues in or is derived from Kenya. This reinforces the principle of territorial taxation, where income is taxed based on its source. Section 48. Income of deceased person, etc. This section addresses the tax liability of income earned by a deceased person. It states that the income is assessed on and the tax is charged on the deceased person's legal representative, executor or administrator. This ensures the deceased person's estate is responsible for paying the appropriate income tax. Section 49. Liability of joint trustees. This section clarifies the liability of multiple trustees when administering a trust. It states that joint trustees are jointly and severally liable for the tax payable on the trust's income. This means any trustee can be held responsible for the full tax amount. Section 50. Indemnification of representative. This section protects individuals responsible for paying tax on behalf of others, e.g., agents, trustees. It allows them to retain sufficient funds from the other person's money to cover the tax liability and indemnifies them against any claims arising from these tax payments. This provision ensures individuals acting in a representative capacity aren't financially disadvantaged by fulfilling their tax obligations. Section 51A. This section was repealed by Act No. 38 of 2016. Part 7 of the Kenya Income Tax Act aims to provide clarity on who is responsible for paying tax in situations involving non-residents, deceased persons, trusts, and representatives. It ensures the tax authorities can effectively collect income tax from various individuals and entities. Understanding these provisions is important for individuals and entities acting in representative capacities and those dealing with non-resident income or deceased estates. Part 8. Obligations for filing tax returns and notices. Part 8 of the Kenya Income Tax Act, titled Returns and Notices, outlines the requirements for individuals and entities to file various tax returns and notices with the Kenya Revenue Authority, KRA. These returns and notices provide the KRA with the necessary information to assess and collect income tax. Section 52. Returns of income and notice of chargeability. This section grants the Commissioner the authority to require individuals to file income tax returns. The returns must include a comprehensive statement of all income earned during a specific year, including income deemed to be theirs under the Act. Details required for tax assessment purposes. A declaration signed by the individual or their representative confirming the accuracy and completeness of the return. This section also defines key terms related to tax returns. Accounts refers to financial statements like balance sheets, profit and loss accounts, and receipts and payments accounts. Professional person. In the context of a company, this refers to someone with a practicing certificate or written authorization to practice accounting, as per the Accountants Act, Cap 531. The section further emphasizes the importance of providing accurate and complete information in tax returns. It empowers the Commissioner to require additional information, including details about significant shareholders, 10% or more, in incorporated entities. Disclosure of beneficial owners in cases of nominee ownership. Complete identification and address details of trustees, settlers, and beneficiaries for trusts. Identification and addresses of all partners in a partnership. Relevant information about business cessation or sale, including liquidation details or new ownership. Section 52A. This section was deleted by Act No. 8 of 1996. Section 55. Books and accounts. This section focuses on record-keeping obligations for tax purposes. It allows the Commissioner to require individuals to maintain adequate records, books, and accounts, specifying the language in which these records should be kept. The section also mandates that businesses preserve all relevant books of account and supporting documents for at least 10 years following the relevant income year. This retention period ensures the KRA has access to historical financial information for audit and verification purposes. There are exceptions to this document preservation rule. Documents or books of account do not need to be preserved if the Commissioner issues a written notification stating that preservation is not required. A company has been liquidated and dissolved, or a business other than a company has ceased operations, and more than 3 months have passed since the person responsible for these records informed the Commissioner of their intent to destroy them. This section explicitly defines a record as encompassing all documentation of income and expenses, purchases and sales, accounts, books, deeds, contracts, and vouchers. Section 56. This section was deleted by Act No. 29 of 2015. Section 57. Return as to salaries, pensions, etc. This section authorizes the Commissioner to require employers or other individuals making specific payments to furnish the KRA with a return detailing these payments. The return must include the name and address of each recipient, the amount of each payment. The section also clarifies that payments for services encompass commissions and reimbursements for expenses, and making of payments extends to any valuable consideration, including non-monetary forms. Section 62. Return as to income exempt from tax. This section empowers the Commissioner to demand returns disclosing income exempt from tax under the Act. This ensures transparency even for income that doesn't contribute to the tax liability. Section 63. Return in relation to settlements. This section grants the Commissioner the authority to require individuals to provide a return of income distributed to or for the benefit of children under a settlement. This helps track income distributions within settlements and prevent potential tax avoidance schemes. Section 64. Return in relation to registered pension fund, etc. This section allows the Commissioner to require trustees or administrators of registered pension funds or schemes, registered provident funds or schemes, and registered individual retirement funds to submit a return outlining their income and the sources of that income. This ensures proper reporting and taxation of income generated by these retirement savings vehicles. Part 8 of the Kenya Income Tax Act emphasizes the importance of accurate and timely reporting of income through various tax returns and notices. It empowers the KRA to request detailed information from individuals, businesses, and those acting in a representative capacity. Understanding these provisions is essential for ensuring compliance with Kenyan tax laws and avoiding potential penalties. Part 9. Tax assessments by the Commissioner. Part 9 of the Kenya Income Tax Act, titled Assessments, outlines the process by which the Commissioner of the Kenya Revenue Authority, KRA, assesses individuals and entities for income tax. Section 73. Assessments. This section establishes that the Commissioner is responsible for assessing every person with chargeable income. This assessment should be completed as quickly as possible after the deadline for submitting the income tax return has passed. The Commissioner can accept the return and consider the declared amount as the individual's self-assessment, or make adjustments and issue a notice of assessment. Section 74. This section was repealed by Act No. 16 of 2014. Section 74A. Installment assessment. This section enables the Commissioner to issue an installment assessment for tax under Section 12 if a person misses the deadline for paying their installment tax. If someone pays their installment tax on time, they are automatically considered assessed for installment tax based on the amount they paid. The other sections in Part 9, specifically Sections 75 through 91A, were deleted by Act No. 29 of 2015. In summary, Part 9 of the Kenya Income Tax Act deals with the assessment of income tax. The Commissioner is responsible for evaluating income tax returns and issuing assessments based on the declared income or adjusted amounts. Understanding this process is crucial for individuals and entities to ensure they are meeting their tax obligations accurately and on time. Part 10. Addressing tax disputes and errors. Part 10 of the Kenya Income Tax Act, titled Objections, Appeals, and Relief for Mistakes, outlines the processes for taxpayers to challenge tax assessments, appeal decisions, and seek relief for errors in their tax affairs. This section is essential for ensuring fairness and due process within the Kenyan tax system. However, the sections previously included in Part 10 of the Kenya Income Tax Act, specifically Sections 82-91A, have been repealed or deleted by subsequent amendments to the Act. For instance, Sections 82 and 83, which likely dealt with the establishment and functions of local tax committees, were repealed by Act No. 40 of 2013. The remaining sections, 84-91A, were deleted by Act No. 29 of 2015. This act introduced significant changes to the tax administration system, including the repeal of provisions relating to local committees and the introduction of the Tax Procedures Act, Cap 469A. While the specific content of the repealed sections is not available in the provided source, it's reasonable to assume that they detailed the mechanisms for objecting to tax assessments. Taxpayers likely had the right to formally challenge assessments issued by the Commissioner if they disagreed with the calculated tax liability. Appealing decisions. If a taxpayer's objection was unsuccessful, they likely had avenues to appeal the decision to a higher authority, such as a tax tribunal or court. Seeking relief for mistakes. Provisions likely existed to address situations where genuine errors were made in tax returns or payments, allowing taxpayers to rectify these mistakes and potentially avoid penalties. Current dispute resolution processes. Although the specific details of Part 10 are no longer in effect, the Kenya Income Tax Act still provides avenues for taxpayers to address disputes and errors. These processes are now primarily governed by the Tax Procedures Act, Cap 469A, and other relevant legislation. For example, Sections 35(6)(d) and 37(5)(a) of the Kenya Income Tax Act allow taxpayers to object to penalties imposed by the Commissioner related to withholding tax and deductions from emoluments. The Act states that objections should be submitted in writing to the Commissioner within 30 days of receiving the penalty notice. Sections 35(6)(e) and 37(5)(b) state that the general provisions of the Act regarding objections will also apply to these specific objection processes. This implies that there is a broader framework for handling tax objections outlined elsewhere in the Act or in related legislation. To fully understand the current dispute resolution processes, it would be necessary to consult the Tax Procedures Act, Cap 469A, and any other relevant Kenyan tax legislation. Part 11. Tax Collection, Recovery, and Repayment. Part 11 of the Kenya Income Tax Act, titled Collection, Recovery, and Repayment of Tax, outlines the procedures for collecting taxes due, recovering unpaid taxes, and repaying taxes that have been overpaid or are eligible for a refund. Section 92. Time within which payment is to be made. This section sets out the general rules for when tax payments are due. Tax is generally due and payable in accordance with the specific provisions outlined in this section, unless otherwise stated in the Act or associated regulations. Section 92A. Due date for payment of tax under self-assessment. For individuals required to file a return under Section 52B, the tax owed is due and payable by the last day of the fourth month after the end of the relevant income year or accounting period. Section 106. Repayment of tax in respect of income accumulated under trusts. If income accumulated under a trust becomes payable to a beneficiary upon the occurrence of a specific event, the beneficiary can claim a repayment of any tax already paid on that income. The claim must be submitted to the Commissioner in writing within 6 years after the end of the income year in which the triggering event happened. Sections 93 to 105 and 105A in Part 11 have been deleted or repealed by subsequent amendments to the Act. The sources do not provide specific details about the procedures for recovering unpaid taxes. It is important to note that this information may be available in other sections of the Kenya Income Tax Act or in separate legislation related to tax collection and enforcement. Part 12. Offences, Penalties, and Enforcement. Part 12 of the Kenya Income Tax Act, titled Offences and Penalties, focuses on actions that are considered violations of the tax law and the associated consequences, including penalties and potential imprisonment. This section underscores the importance of adhering to the tax regulations outlined in the Act. Section 107. General Penalty. This section establishes a general penalty for any offense under the Act that does not have a specific penalty defined elsewhere. If found guilty of such an offense, an individual could face a fine of up to 100,000 shillings, imprisonment for up to 6 months, both a fine and imprisonment. Section 108. This section was repealed by Act No. 15 of 2017. Section 109. Failure to comply with notice, etc. This section outlines specific actions that constitute offenses if done without a reasonable excuse. These include failing to furnish a return as required by Section 35 of 5, which pertains to providing information about payments for services rendered. Failing to submit a complete and accurate return as requested in a notice issued under the Act, or neglecting to notify the Commissioner as mandated by Section 52(3), which deals with changes in address or representative. Failing to provide the Commissioner or any other authorized person with required documents within the specified time frame, as stipulated by the Act or a notice served under the Act. Making an incorrect or misleading statement in a return or other document submitted under the Act, or negligently omitting required information. Obstructing or hindering the Commissioner or an authorized officer in the performance of their duties. Aiding, abetting, or inducing another person to commit any of the above offenses. The remaining sections in Part 12, specifically Sections 110 through 121, have been deleted by Act No. 29 of 2015. While the specific details of some of the deleted or repealed sections in Part 12 are not available in the sources, they likely focused on penalties for specific tax offenses. The Act probably included separate sections outlining penalties for specific violations, such as failing to file returns on time, underreporting income, or claiming ineligible deductions. Enforcement procedures. There were likely provisions detailing how the KRA would investigate and prosecute tax offenses, when the legal processes involved in collecting unpaid taxes and imposing penalties. Changes introduced by Act No. 29 of 2015. Act No. 29 of 2015, which deleted numerous sections from Part 12, also introduced the Tax Procedures Act, Cap 469A. It's highly probable that many of the provisions related to tax offenses, penalties, and enforcement that were previously in Part 12 are now incorporated into the Tax Procedures Act or other relevant legislation. To gain a complete understanding of the current framework for tax offenses and penalties in Kenya, you should refer to the Tax Procedures Act, Cap 469(8), and any other relevant Kenyan tax laws. Part 13. Administration and Implementation of Tax Laws. Part 13 of the Kenya Income Tax Act, titled Administration, deals with the practical aspects of implementing and enforcing the tax laws. This part focuses on the authority responsible for managing the tax system and the procedures for enacting and enforcing tax regulations. Key provisions of Part 13. Section 130. Rules. This section empowers the Cabinet Secretary to issue rules that clarify and elaborate on various aspects of the Income Tax Act. These rules are crucial for providing detailed instructions on implementing the Act's provisions. They cover procedural matters, definitions, forms, and other aspects necessary for the smooth operation of the tax system. Section 131. Exemption from stamp duty. This section exempts specific transactions from stamp duty, a tax levied on legal documents. Any security or transfer of property in favor of or by the Commissioner is not subject to stamp duty. This exemption likely aims to streamline the process of collecting taxes and managing KRA assets. Repealed and deleted sections. Sections 122 to 129 and 127d, 128 in Part 13 have been either repealed or deleted by amendments to the Act, particularly Act No. 29 of 2015, which introduced the Tax Procedures Act, Cap 469A. It's likely that many of the provisions previously included in these sections, such as those related to administrative procedures, record keeping, and enforcement mechanisms, have been moved to the Tax Procedures Act or other relevant legislation. Transitional Provisions, Section 133 and 6th Schedule. Section 133 highlights that the 6th Schedule contains transitional provisions. These are rules designed to ensure a smooth transition from the previous Income Tax Act, referred to as the Management Act, to the current version. Some key points from the 6th Schedule include: Paragraph 3. It clarifies that the term provision in this schedule encompasses various tax-related actions, including assessments, deductions, and returns. This ensures that the transitional rules apply to all aspects of tax administration. Paragraph 4. This paragraph addresses situations where a taxpayer had a deficit, loss, in their total income for the year of income 1973. In such cases, the computation of their total income for the year 1974 should be done as if Section 13(4) of the Management Act, the previous tax law, still applied. This provision aimed to prevent taxpayers from being unfairly penalized due to the change in legislation. Paragraph 10. It ensures the continuity of local committees and their members, who were initially appointed under the Management Act. They are authorized to continue operating as if they had been appointed under the current Act. Paragraph 11. This paragraph focuses on refunds or returns of contributions made under various retirement savings plans before the enactment of the current Act. Such refunds are considered income subject to tax, aligning with the provisions of the Management Act and Section 3(c) of the same Act. Paragraph 13. This provision outlines special rules for handling insurance policies taken out by employers for their employees before the commencement of the current Act. The treatment of these policies for tax purposes is determined based on specific events, such as the assignment of the policy, the employee leaving the service of the employer, or the death of the individual. This paragraph ensures clarity and fairness in handling these pre-existing policies. Key concepts related to Part 13. Administrative authority. While the sources don't explicitly state the specific authority responsible for administering the Income Tax Act, the powers granted to the Cabinet Secretary in Section 130 suggest a high level of government involvement. This is consistent with the role of the KRA in managing the overall tax system in Kenya. Enforcement and compliance. Although the specific details about enforcement procedures are not provided in Part 13, the power to issue rules and the exemption of KRA transactions from stamp duty highlight the importance of ensuring compliance with the Income Tax Act. These provisions imply that the KRA has mechanisms in place to enforce the tax laws and collect taxes due. To get a more comprehensive understanding of the current administrative framework for tax administration in Kenya, it's essential to refer to the Tax Procedures Act, Cap 469(8), and other relevant Kenyan tax legislation. Part 14. Miscellaneous Provisions and Definitions. Part 14 of the Kenya Income Tax Act, titled Miscellaneous Provisions, serves as a catch-all for various rules and definitions that don't fit neatly into other parts of the Act. This part plays a crucial role in ensuring the Act's comprehensive and effective application. Section 2. Interpretation. This section is dedicated to defining various terms used throughout the Income Tax Act, ensuring clarity and consistency in interpretation. Some key definitions include: accounting period refers to the period covered by a person's business accounts. Actuary defines an actuary as a member of specific professional actuarial organizations or someone with equivalent expertise approved by the Commissioner of Insurance. Bank defined as a bank or financial institution licensed under the Banking Act, Cap 488. Business encompasses trades, professions, vocations, manufacturing ventures, and concerns similar to trade but excludes employment. Contract of service refers to an employment agreement, whether spoken or written, for a specific period and includes apprenticeships. It emphasizes the employer's authority to hire, fire, set wages, and control the work. Employer includes any resident responsible for paying emoluments to employees and any agents acting on behalf of non-resident employers in Kenya. Immovable property includes land, any rights associated with land, and things permanently attached to land. It also covers mining rights, interests in petroleum agreements, and mining or petroleum information. Interest defined as any payment related to loans, deposits, debts, claims, or other financial obligations. This includes premiums, discounts, commitment fees, service fees, and returns from Islamic finance arrangements. Loss explained as a loss calculated using the same method as gains or profits. Section 2(1)(a). This provision allows for the flexibility of keeping accounts, books, and other records required by the Act in various formats, including written form, microfilm, magnetic tape, or any other electronic data retrieval method. This recognizes the increasing use of electronic record keeping in modern business practices. Section 2(2). This subsection addresses situations where an order relating to tax rates or personal reliefs has been issued under the Provisional Collection of Taxes and Duties Act, Cap 415. It clarifies that as long as such an order remains in effect, the rates and reliefs specified in that order supersede those stated in the Income Tax Act. If the rates or reliefs are subsequently amended in the Act and differ from the order, adjustments to assessments will be made to reflect the updated rates and reliefs. Section 4(b). Export Processing Zone Enterprise. This section specifies that businesses operating within export processing zones are subject to the provisions outlined in the 11th Schedule. The 11th Schedule lays out specific tax rules for these enterprises, including a corporate tax exemption for the initial 10 years of operation and a reduced rate for the subsequent 10 years. The sources do not provide specific details about the other miscellaneous provisions within Part 14 of the Kenya Income Tax Act. However, the inclusion of such a part suggests the need for provisions dealing with a range of issues not addressed elsewhere. Some potential topics covered in Part 14 could include anti-avoidance rules, provisions aimed at preventing taxpayers from using artificial or contrived arrangements to reduce their tax liability. These rules typically target transactions lacking commercial substance or those primarily designed to exploit loopholes in the tax law. Penalties for late filing or payment. Part 14 may include specific penalties for failing to file tax returns or pay taxes by the deadline specified in the Act. These penalties often involve a fixed amount or a percentage of the unpaid tax, increasing with the length of the delay. Provisions for resolving disputes. The Act likely contains procedures for resolving disputes between taxpayers and the KRA, including mechanisms for filing objections and appeals against tax assessments or decisions made by the Commissioner. These provisions are essential for ensuring fairness and due process in tax administration. Rules governing tax audits and investigations. The Act might contain rules regarding the KRA's power to conduct tax audits and investigations, including the procedures for selecting taxpayers for audit, the scope of the audit, and the taxpayer's rights and obligations during an audit. To fully understand the scope and implications of Part 14, it is necessary to review the entire part and any associated regulations or guidelines issued by the KRA. A Guide to the Kenya Income Tax Act Schedules. The Kenya Income Tax Act includes several schedules that provide detailed information on specific aspects of the tax law. These schedules are essential for understanding how the Act applies in practice. Here is a simplified explanation of some of the key schedules. First Schedule. Exemptions. The first schedule lists various types of income that are exempt from income tax in Kenya. These exemptions can apply to individuals, organizations, or specific sources of income. Some examples of exempt income include income expressly exempted by other acts of parliament, income of specific organizations, such as religious institutions or charities, as provided by law, income from certain government securities, income of registered pension schemes, income or principal sum of a registered family trust. Second schedule. Investment allowance. The second schedule deals with investment allowances, which are tax deductions allowed for investments in certain assets used for business purposes. This schedule has been repealed, but some provisions, like paragraph 24E, remain in effect until December 31, 2024. The schedule outlines rules for calculating balancing charges or deductions when a business ceases to operate or disposes of assets. This ensures that the tax benefits received for investments are adjusted when the asset is no longer used for the intended purpose. Determining the market value of assets used in a business. This is important for calculating the tax implications of transactions involving these assets. Third schedule. Rates of personal reliefs and tax. The third schedule specifies the rates for personal reliefs and different categories of income tax. This schedule is crucial for determining the amount of tax payable by individuals and businesses. It includes rates for personal reliefs, such as insurance relief, which allows individuals to deduct a portion of their insurance premiums from their taxable income. Resident and non-resident tax rates. Non-resident tax rates apply to income earned by individuals or entities not residing in Kenya. These rates can vary depending on the type of income, such as management fees, royalties, dividends, or interest. Tax rates for specific types of income, such as rental income, winnings, or income subject to turnover tax or digital service tax. Fourth schedule. Financial institutions. The fourth schedule lists specific financial institutions subject to special rules regarding withholding tax on interest payments. These institutions include banks licensed under the Banking Act, building societies registered under the Building Societies Act, entities licensed under the Hire Purchase Act, such as companies involved in financing the purchase of goods through installment plans. Fifth schedule. Scheduled professions and qualifications. The fifth schedule outlines specific professions and the required qualifications for individuals to be recognized as professionals in those fields for tax purposes. For example, it lists medical practitioners and dentists who must be registered under the Medical Practitioners and Dentists Act. Engineers registered under the Engineers Registration Act. Accountants registered under the Accountants Act. Sixth schedule. Transitional provisions. The sixth schedule contains transitional provisions designed to ensure a smooth shift from the previous income tax law, referred to as the Management Act, to the current Income Tax Act. These provisions aim to address situations that arose under the previous law and ensure a consistent application of the tax rules during the transition period. Key points include clarification that the term provision encompasses various tax-related actions, including assessments, deductions, and returns, ensuring that transitional rules apply broadly. Rules for calculating total income for the year 1974 if the taxpayer experienced a loss in 1973, preventing unfair penalties due to the change in law. Continued operation of local tax committees appointed under the Management Act as if they were established under the current Act, maintaining continuity in tax administration. Specific rules for handling refunds of contributions made to retirement savings plans before the current Act, aligning with the provisions of the previous law. Rules for determining the tax treatment of insurance policies taken out by employers for their employees before the current Act, ensuring clarity and fairness. 7th Schedule. Special provisions on community employees. The 7th Schedule has been deleted. 8th Schedule. Accrual and computation of gains from property. The 8th Schedule covers the calculation of capital gains tax on the transfer of property, excluding investment shares transferred by individuals. This schedule defines key terms like adjusted cost and transfer value and provides rules for determining when a transfer of property occurs for tax purposes. Calculating the transfer value, which is the amount subject to capital gains tax. Determining the adjusted cost of the property, which is used to calculate the taxable gain. Addressing situations where property is transferred between related parties or for a consideration that cannot be easily valued. 9th Schedule. Taxation of extractive industries. The 9th Schedule focuses on the taxation of activities related to mining and petroleum operations. It includes specific rules for defining key terms, such as mining right, petroleum agreement, and exploration expenditure. Taxing licensees, who are individuals or entities granted rights to extract minerals. Taxing contractors, who are entities that have entered into agreements with the government for petroleum exploration and production. Handling farm-out agreements, where a licensee or contractor transfers an interest in a mining right or petroleum agreement in exchange for the transferee undertaking work commitments. Taxing subcontractors providing services to licensees or contractors in mining or petroleum operations. 10th Schedule. Agricultural produce and authorized agents. The 10th Schedule is not included in the provided source excerpts. 11th Schedule. Taxation of export processing zone enterprises. The 11th Schedule sets out specific tax rules for businesses operating in export processing zones. These zones are designated areas with special incentives to encourage export-oriented businesses. Key provisions include the requirement for these enterprises to maintain their accounts in a convertible foreign currency approved by the Commissioner. 12th Schedule. Provisions relating to installment tax. The 12th Schedule provides detailed rules for calculating and paying installment tax, which is a system where taxpayers make regular payments towards their estimated annual tax liability throughout the year of income. This schedule outlines the proportions of the estimated tax liability that are due at specific times during the year. Rules for estimating the current year's income for calculating installment tax payments. This summary provides a simplified explanation of the Kenya Income Tax Act schedules, focusing on the key aspects relevant for understanding the practical application of the tax law. Keep in mind that these schedules are just one part of the Act, and it is crucial to refer to the complete Act and any relevant regulations or guidelines issued by the KRA for a comprehensive understanding of Kenyan tax laws.